Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets, from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings, John. It's great to have you on the podcast show.
Thank you, Bilal. Happy New Year. It is an honor, I must say, to be your first podcast of 2024. I look forward to it.
Likewise, it's great to have you on. Now, before we get into the meat of our conversation, as you know, I always like to ask about the origin story of my guests. So why didn't you tell me something about your origin story, what you studied at school? Was it inevitable you'd end up in finance, and then some of the sort of key milestones of your finance career?
Okay. If I could, I'm going to take a little bit of artistic liberty in answering this question. Let me go back to the late 1990s when I decided to drive my motorcycle by myself across the US.
Okay.
And I think it has something to do in terms of my origin story. I had a destination in mind to go from New York to California. I had the motorcycle, and I had desire for a little bit of adventure and seeing the country and meeting different people. But I wasn't exactly sure what path I was going to take. I would literally wake up in the morning, go to a local diner, have breakfast, talk to some of the locals, and look at my map and look at the weather and decide which way to head. And I'd adjust my path along the way. I was fortunate to not have any accidents, but I think that has some parallels, to my origin story, and how our lives, both professionally and personally, occur over time. So more specifically to your question, I grew up in New Jersey. I was fortunate in my early teens for a family job opportunity to move to the Caribbean on the island of St. Croix, where I lived for a number of years. So it was a fantastic time. Learned how to scuba dive, to sail, met some great people, many of my early mentors. After a few years, I got a little bit of island fever. And I had heard of something called boarding schools. I decided to go to the local library, in an old school fashion, pull out the Barron's Guide to Prep Schools, I think it was called. And I was lucky to apply to Andover in Massachusetts. They offered me a scholarship, and away I went at a fantastic liberal arts schooling there. I met some lifelong friends. Prior to going to St. Croix, I had taken an interest in running during the running boom of the 1970s and 80s when I was about 8 years old. I was always an athlete growing up, and I was always interested in business. And I decided that I would pursue my running career and pursue my business career and go to Villanova undergraduate business school just outside of Philadelphia. One of the, key things, going back as long as I can remember, I was always interested in having a faculty for math, for trading, for travel. I used to collect stamps and read about places like Indonesia and their currency, their economy, the population, how it changed over time. I used to trade baseball cards, have paper routes, trade stamps, reading about oil during the crises in the 1970s, and began collecting and trading currencies. After Villanova, I was fortunate to be offered a role in the analyst program at Merrill Lynch. And I was eventually recruited into a growing area at Merrill in the currency business. A sales role covering hedge funds eventually led to a role trading proprietarily, trading both currencies and interest rates. And from there, I was offered an opportunity to move to the buy side by some clients. And since that time, I've been managing macro and currency portfolios for over 20 years now. I don't think it was ever inevitable what path I was going to take. But similar to the motorcycle story I told you, somehow the core pieces fit together and your journey kind of finds itself. And for me, love of markets, trading, risk taking, and all the facets that drive the world, both, economically, geopolitically, has allowed me, to create a fantastic life, being a trader.
No, that sounds great, and it does sound like from a very early age you sort of built up this intuition and this interest in risk, in a sort of general sense, whether it was trading cards, baseball cards, or stamps, and then later motorcycle, riding across the country. So it's kind of an interesting upbringing that you had, which now looking back sounds like the ideal kind of training ground almost to become a risk taker, I suppose.
I think so. I have to admit, there were always calculated risks, and I was always careful. For example, I did a lot of mountaineering, both rock climbing and ice climbing. And ice climbing was something that I was very leery of and didn't really take to. It just seemed too fluid, for lack of a better term. And I think that's also, as you said, factored into how I manage risk, and looking for asymmetric returns and really protecting, the downside. I've been fortunate in my trading career to have a number of different opportunities to manage portfolios with different investment mandates across multiple asset classes, whether it be currencies, bonds, equities, commodities. And I've been able to kind of take that very, very varied background, trading, say, pure absolute macro, and making, 10 to 20% with sharps above one. I've also been able to take that and to trade that macro view in the currency world, where for over a decade, I ran one of the best performing currency only funds. Then I've also been able to take that risk view, and trade currencies, with a risk off tilt, which I was able to do through the 2010s, with a negative 0.5 correlation to the S&P 500, and still eke out some small gains, despite the fact that risk markets all around the world, went straight up pretty much.
And so in terms of your approach to coming up with a trade, so obviously asymmetric trades manage the risk, but you want, trades that will give you nice big gains. I mean, what's your process in doing this? Because at least when it comes to macro, there's almost like an infinite amounts of inputs. So you could look at almost anything and everything. And then at the same time, also you need to have the sensitivity to, okay, what's priced in, what's consensus and so on. And then there's a risk management side as well. So, I mean, can you just talk through in a generic sense, what your process is to come up with an idea?
Yeah, absolutely. It's a great question. And as you said, there's an infinite number of ways to solve for things, and there's infinite amount of information that you have to process. And the first thing is you have to figure out what you're solving for. What is the investment mandate? The investment mandate, in terms of generating performance aid for a pension fund or endowment, and the risk profile you're going to take, is going to be much different than something that you're trading for, a hedge fund that's looking to generate 10+% returns, with a high Sharpe ratio that's going to have a more truncated time horizon. But in any of those scenarios, the first principle, is you're looking to find and leverage asymmetric outcomes in both your expected return, compared to the potential risk that you're taking. And you can boil that down, to a simplistic version of I'm looking for a risk to reward ratio of 5 to 1 on any single trade. And from there, you can build the multi-dimensional aspects, to that. But the first principle is, you're looking at, the expected return versus potential risk, which is a function of the probability of something happening as well as the distance between the 2 points. Now, the dynamic part of that, because this is never a fixed system, right? This is kind of a complex, adaptive system, both in terms of the macro environment and in terms of how you have to manage the portfolio. you need to identify, the components that are the drivers of any particular trade and how they increase and decrease over time, because the probabilities of success of that trade are going to change the lifespan of that trade. And that's where you get into some of the things that you mentioned, like market positioning and the microstructure. What quant factors are driving the markets is, say, for example, in dollar yen, is the interest rate differential between the US and Japan, the primary driver of the directional movement. The other part is you have to accept, the inherent uncertainty in any trade that you put on, and accept that you're going to be right sometimes, but in many cases, you're going to be wrong more than you're right. And I would say
And actually, on that specific point, one of the things I've noticed, or one of the challenges I would say of trading markets is psychologically, how do you deal with periods of underperformance or drawdown? Because that could easily cause you to, just unravel, from a basic human level, but also you could lose discipline, around your process, or maybe you need to question your process. But how do you deal with sort of periods of underperformance? When the uncertainties, on the downside.
Mhm. Yeah, I think there's two parts to that. There's the psychological side, and there's the actual portfolio component. On the psychological side, you need to do a reset. You need to maybe step away from the markets a little bit. Maybe you need to go for a long run, or tennis, whatever your sport is. Do some thinking, do some reading, and step away psychologically, and reset. From a risk standpoint, you need to pare back the amount of risk you have, either through the size of positions, the number of positions, and maybe restructure the portfolio. If you had outright trades on, maybe you should shift them to something where you have options, where you have clearly defined risk, and it allows you a little more latitude to step away from the day-to-day or minute-to-minute, actions in the market.
I mean, is there a possibility there that you de-risk your portfolio at the wrong point when you're about to have a comeback?
Absolutely. There's always that risk. And I think part of, the psychological process and part of the risk process, is to quickly, get a psychological reset so that you are not away from the markets, or you're not resetting while something is, your trades are going to start to work. And also when you're de-risking, you want to do it, reduce the trades that you think have the least probability of success, and keep the trades either in smaller size, or through options that you feel most strongly about. So
Yeah, no, I understand. So, I mean, the key component there, I suppose, is you have to have that psychological reset to approach your portfolio rationally, in a rational way, to de-risk it, and de-risk the right parts of the portfolio. So what you don't want to do is, still be psychologically scarred and then, be flailing around managing your portfolio, So I can see, as you say, to have sort of both things working in the right way.
Yeah, and I think the other thing to remember is there will be plenty of trading opportunities. And yes, it's disappointing to de-risk and to have a trade start working in your favor and to miss that opportunity. But part of the process and part of the journey, whether it's a motorcycle trip or your career, is to continue getting better, and improving upon your weaknesses, but also recognize functionally in the market, there will be other opportunities to make money. The most important part, is surviving, and protecting the downside risk in your portfolio.
Yeah, that's a great point to make there.
And I would say, as an extension of that, one of the most important things in risk management is variable position sizing, based off, the perceived opportunity set, and based off the evolution of the trade. Not every trade should be sized the same. You're going to have trades that start to work for you, or that you feel very strongly about, where you should make a disproportionate amount of the gains. That you can do that asymmetrically through options, or through sizing outright trades with proper timing. That will make a tremendous difference in both your asymmetry to the right side and reducing the drawdowns.
Yeah, that's great. Great observation there as well. Now let's move into the sort of here and now. Obviously, with start of 2024, we could talk about 2024 views, but before we do that, I just wanted to, ask you what are some of the lessons you think we should learn from 2023 as we start to trade this year, the new year?
Yeah, it's a great question, and it's got obviously many different answers to that in terms of the market moves, and what it means in terms of both capitalizing on the opportunities in 24, as well as recognizing what happened in 23 and what might repeat and what might change. And I would say there's a couple meta lessons from 2023. One is that we're in a new investment and macroeconomic regime. The 2010s were the anomaly of subdued economic data volatility, subdued market volatility. And the 2020s are really going to be higher volatility markets, higher dispersion amongst economic data on both the growth and inflation side. And that's going to drive a significant change in the opportunity set, but a different way we need to approach the markets. So that's number one. I think number two is take a lesson from cognitive psychology and chunking. You need to adapt to the markets, and you need to chunk your investments and build them over time throughout the year. Take fixed income in 2023. There were three big opportunities for multi-standard deviation moves, and yet fixed income ended the year basically flat.
No, that's a great point. I mean, if you look at the change on the year at zero, but we had meaningful trends, during, as you say, three distinct phases. So there was a real opportunities there, and whereas we think in calendar time, I suppose, but you're saying we need to look at sort of, chunk time or, intra period time or phases.
I think you need to, yes, and those phases will vary in terms of duration. But you need to recognize the type of market you're in. And that's going to be based upon the evolution of the macroeconomic fundamentals. It's going to be based on how the market's positioned, as we saw in March of 2023. And then again, in the beginning of November of 2023. And then in the sell-off that began in the summer of 2023. All those were very distinct periods that provided significant opportunities, but you had to be adaptive to capture them, and you had to structure your portfolios properly. I would say a few more is, economic predictions and market predictions are very, very difficult in this new paradigm in the 2020s. The post-COVID world of understanding and predicting what the consumer is going to do, what the government is going to do. Sample sizes have decreased in the economic data. If you look at beginning of 2023, 85% of the market expected a recession in 2023. Market expectations of central bank easing got continually pushed out. Tech stocks massively outperformed. So I think you need to be very flexible and multifaceted in terms of the analytical techniques, the risk management, the trade timing, how you're expressing views. The other meta lesson I would say is AI is here to stay. And the power and usage of AI is only going to accelerate. It may be ironically that some of the Magnificent Seven stocks don't quite do as well as they did in 2023. I don't think that would be a surprise, but maybe newcomers enter the arena, the adoption of AI into our everyday work really begins to accelerate. So I think that was a meta lesson of 2023. It's here to stay and it's going to rapidly accelerate. And I would say the last one, which ties into the others, is that you really need to follow a differentiated perspective and approach. There's too many people out there using similar trading styles, taking similar research inputs, using similar risk models. And you need to identify what works for you, what your investors want, and create a differentiated approach to the markets to generate differentiated returns.
No, there's a great lessons there. So let's kind of move into 2024 then. I mean, so, what are your sort of general high level thoughts for this year?
I think 2024 is going to be more alpha than beta. Consensus now is for a soft landing. They don't usually happen. It doesn't mean it isn't going to happen. But I think the likelihood is we don't get a soft landing. We either get a hard landing, or for whatever reason, the economy continues to chug along at 2 to 3%, and inflation is relatively benign. It may not go back to 0 or 2, but maybe it's between 2 and 4%. I think the other interesting thing, given how wrong the predictions were in 2023, in 2024, the predictions for both growth and inflation are very tightly bunched. There's very little in the way of fat tails in terms of the predictions for the outcomes of growth or inflation in 2024. So what I think that means is broadly, you're going to continue to see an increase in volatility on a sustained basis. It may be episodic at times, but particularly for currencies, which saw a decline in volatility throughout 2023, I think that's going to change. And I think you're going to see a pickup in currency volatility throughout 2024 as divergences between growth and inflation, and through that interest rates continues to grow amongst countries around the world in different regions.
And in terms of the differentiation across the regions, what's your take on US risks versus, say, China risks? Because there's the two major blocks there. How are you thinking about those?
Well, I think in the US, the key question is the US consumer. If you just do the math, the consumer is 70% of the economy. There's clearly some risk that the consumer is going to see a slowdown. Student loan payments are restarting. They're a significant part of income. We're seeing a bit of cooling already as credit card and auto delinquencies go up. One thing to be cautious of is the consumer balance sheets are relatively healthy. And this only live once, view coming out of COVID means the consumer can continue to surprise on the upside, which could keep the economy a bit stronger than expected. I think that the credit cycle, though, is starting to turn. Corporate defaults are rising. Lower rated companies employ a relatively large percentage of the workforce. So if you start to see credit spreads widen because the economy is slowing, you may see that feed through to higher unemployment rates. And the other big risk is in commercial real estate. I don't think those risks have cleared. There's 500 billion to roll over in 2024. Credit's tighter. Vacancy rates are around 16%, which is higher than they were in 2008. So I think all those factors are going to be the key things to watch as we move through 2024.
And just on the CRE, the commercial real estate, I mean, why do you think it didn't sort of really blow up last year? Because people were talking about that, especially when we had that big focus on regional banks, Q2-ish last year. I mean, why do you think this didn't blow up?
Well, I think the authorities and the Fed did a very good job in managing it, providing a backstop for bank portfolios. And I think they're able to stem the deposit outflows and really engender confidence. But that doesn't mean that we won't continue to have a reset lower in prices. That doesn't stop the rollovers that need to occur over the next year, several years, for that matter.
Yeah. And then on China?
Look, China has become, a known quantity. It was a surprise in 2022 in terms of the currency weakness and the unraveling of the property sector. It was a surprise in 2023 that China didn't recover strongly post the COVID opening. Consumers didn't really spend; they chose to pay down debt. I would, prefer to think about China much more like a tactical trading vehicle right now that's going to influence not just the Chinese stock market and Chinese currency, but will influence currencies in the region that are linked to China. So, for example, Australia. I think, stepping away from China for the moment, I think one of the most exciting opportunities of 2024 is Japan. Japan is seeing cyclically strong performance turning into secularly strong performance. The productivity improvements are becoming explosive as the reforms are beginning to channel corporate earnings and private savings in productive investments. The demographics are finally being addressed through more women entering the workforce. The foreign share of labor has gone up in Japan. Abenomics, which started in 2012 with the 3 arrows, is finally starting to see the third hour of regulatory and structural reform kick in. There's a substantial change and difference between what's happening in Japan and what's happening in the US and the rest of the world. And I think that means one of the great trades of 2024 is to continue to see the Japanese stock market power higher, to see the yen substantially outperform. You included the piece that I wrote in the Gray Swans. It's already moved a little bit, but I think yen being one of the most undervalued currencies in the world, interest rates differentials beginning to converge between the US and Japan, and the momentum that can be established can see the yen continue to appreciate back down to 100 to 120.
And just on the yen and Japan, you laid out the case for obviously the economy to do well. Implicit behind that, I suppose, is also that the Bank of Japan will tighten policy. And do you think it's possible for the Bank of Japan to tighten / be hawkish over the course of this year if the Fed and other central banks are cutting rates? So that's obviously a compelling divergence, but will the Japanese really be comfortable with that?
I think they've told you they're comfortable with it. The Bank of Japan has done a masterful job of essentially, ending yield curve control with the market not even knowing it. It's been a phenomenal effort. And if you go back and you read, what the academics and the BOJ governor has written over the past 10 or 20 years, and you look at what they learned from people like Stan Fisher, you can see a very pragmatic and tactical approach a deep understanding and appreciation for the markets. And the key to this trade is that the direction of travel in the macroeconomic structure of the economies, and through that, the monetary policy channels has changed. Japanese wage inflation is going up. Overall inflation in Japan is going up. Japan is reforming. The number of shareholder resolutions is increasing dramatically in Japan, and it's being reflected in both the stock markets. It's being reflected in the currency, and it will also be reflected in the interest rate markets.
And it sounds, in terms of macro themes, the Japan story is something that you think is a fairly compelling theme for over the course of the year as a whole. And it sounds almost like you don't want to get too bogged down into will the BOJ hike in March or April, or kind of these like more tactical type, perspectives, because there's a general story here. Is that fair to say?
Yes, it's absolutely fair to say. I think it's very difficult to, predict individual central bank meetings. But what we do have a higher probability of predicting and following is what the direction of travel is going to be. And importantly, identify the one or two factors that may cause the direction of the trade to accelerate or to reverse. In Japan, it's the reform and it's inflation. And both those things continue to seem to be moving in the direction that would engender a stronger currency and higher rates and a higher stock market.
And let's then talk actually about the dollar in general. So, the dollar, if you look back historically, it's still trading at relatively high levels, close to sort of multi-decade highs. We've had some softness in the dollar, Q4 of last year. So do you have a view on the big dollar? So obviously you do expect dollar to weaken against the yen, but do you think we'll see general dollar weakness over the course of this year?
I think it's going to be much more nuanced. And I think this is going to be much more of a year in currencies and in macro broadly about generating differentiated alpha as opposed to big one-dimensional moves. So I think that, for example, in Switzerland, I think that the Swiss currency will underperform in 2024, again, as the Swiss National Bank moves to an easing policy, and they use the currency to create that easing through reducing the amount of Swiss they're buying, and through encouraging currency weakness, given that inflation is below target and growth is slowing. So in that case, it'd be short Swiss. I think that both the euro and pound will underperform. I think there'll be a lot of opportunities to trade tactically in the high beta pairs. Again, looking back at how China might get drier, some of the high beta pairs that are commodity sensitive, like Aussie, Kiwi, Canada, NOK, those will be opportunities to trade throughout the year, depending upon the ebbs and flows in China. We'll have to see what happens in the Taiwan elections in mid-January. But I think that also ties into, my view on commodities, where gold has the potential to keep moving higher in most scenarios. And broadly, the commodity index is at the lower end of the range for the past few years. Oil is going to remain volatile due to both supply and demand issues. We've got the geopolitics, clearly, we've got economic activity. But if you look at, say, underinvestments in new projects in the oil industry, that's going to continue to tighten supply. Employment in the U.S. oil and gas sector is at multi-decade lows, and the U.S. has run down the SPR. So I think these are factors that are going to allow you to generate alpha by trading pairs on both a directional and relative value basis within the currency universe.
And on geopolitics, I mean, that's an interesting one where obviously we see the news in the Middle East. And it seems like it's with the whole Yemen situation, it's escalating. Obviously, as a trader, then, or as a risk taker, obviously there is this Middle East risk and war risk and so on. But at the same time, I mean, do we have an alpha, trading these sorts of headlines or not? I mean, how do you look at geopolitics when you think about markets?
Well, I think you definitely have an alpha, but I think you have to find other ways to generate that alpha, and you have to use different tools to create that alpha. And by that, I mean you have to spend more time following geopolitics. You have to find more experts to talk to. You have to think outside the box and consider what's priced in and what's not priced in. And you have to adjust, the size of your positions, where you're positioned, and how you're positioned. So perhaps you may want to use more options than outright trades. Perhaps you might want to reduce your risk in trades that could be particularly sensitive to, the evolution of geopolitics. I would say, getting back to your dollar question broadly, I think the U.S. election is clearly it's on people's radar screens, but I think it could be much bigger in terms of impacting markets than is expected. We still may have a third party candidate. No matter who wins, whether it's a Democrat or Republican, for a third party candidate, it's unlikely. You have the risk of further social unrest. And you have, importantly, the sunsetting of current tax policy in 2025. And that has massive implications for CapEx, personal and corporate taxes. And we're very likely to see the introduction of a VAT tax in the US. And that has implications for the budget deficit, debt cost, debt servicing, and clearly for the dollar through both the macro economic and fiscal dynamics, but also depending upon who's president.
I mean, on the dollar, then, I mean, it could go either way, I suppose, depending on how the election unfolds. I mean, if there's social unrest, then presumably that's bad for the dollar. If there's policies that could bring in the budget deficit, that could potentially be positive, but that could have an impact on growth. Could you lay out some scenarios for elections and the dollar?
That's a very difficult question, and that's a long way off. I've had enough challenges making money in the first month of the
That's fair
year.
enough. Yeah.
I tend to come in too hot in January, so I would approach things much more cautiously. These are things that I think you need to keep in your mind as to these are the potential directions of travel.
Yeah.
These are the one or two things I should watch, and then you can generate the trades and create the opportunities.
Yeah. And I know you also look at emerging market currencies as well, and you wrote another piece for us on Turkey as well. Turkey obviously has gone through its own, sort of different phases of heterodoxy and orthodoxy and so on. Could you talk to some of the emerging markets that you think could be interesting over this year?
I think emerging markets are a fantastic opportunity. Amazingly, through good macro policies, through the improvement of trade balances, through the buildup of reserves, emerging markets have not really had any broad crises over the past, several years. And I think that it also allows themselves a great opportunity that each region allows specific opportunities and specific trading styles. In Latin America, I think Brazil is going to continue to outperform. Currency will do well. The stock market will do well. The currency is undervalued. Real rates are still very high. The terms of trade continue to improve. If we do get a bounce in commodity prices, Brazil will be the beneficiary. In Eastern Europe, I think it's much more nuanced. I think Poland will be the beneficiary of higher rates over 2024, whereas places like Shep will see easing, weaker growth, and the currency will underperform. Talking about Turkey, it's clearly a wild card. I would structure a trade there through 6 months or 1 year call spreads or calls on the Turkish lira. And the piece
So
that I
Turkish
wrote,
strength, basically, the currency
Turkish
strength,
strength,
the local
yeah,
currency strengthened against the
yeah.
dollar. Yeah.
And the piece that I wrote for you, amazingly, is kind of the mirror image of a piece that I wrote in August of 2020, calling for Turkish weakness. In that you're seeing an improvement in the reserve situation now. You're seeing an improvement in heterodox policies, monetary policy. You're seeing an improvement, and you'll probably see Turkey have positive real rates this year. You're seeing an improvement in the current accounts. You're seeing improvement in the credit cycle. And clearly we have a ways to go. But Turkey is one of those trades structured properly where you can get 5 to 1, 10 to 1 in a very controlled risk way to the portfolio. And I don't think many people are following. I think it's kind of fallen off the radar screen. And getting back to your question on emerging markets, I think one of the unique aspects of emerging markets is it's really been underinvested over the past several years. The flow to EM and to Turkey in particular, but more broadly, have been very muted. And I think, if the dollar is at best stable or weakens throughout 2024, that's going to be a tremendous tailwind for emerging markets.
Yeah. And look, we haven't talked explicitly about US rates. I suppose there's two stories here. One is the amount of easings that are priced in for this year, so the front end. And then the other question is the whole steepness of the curve, term premia, supply issues, fiscal risk, and so on. Do you have thoughts on either one of those two?
I do. And I think it's the 2023 playbook, trade actively. There's 6 easings, give or take, priced in right now. That's a tremendous amount of easing, given the calendar and given the election in 2024 in the US, and given the uncertainty and the volatility of economic data. We've had a tremendous rally in risk markets since the beginning of November. It's been much stronger than seasonally has occurred in the past across all asset classes, currencies, stocks, and fixed income. So I think you need to be very active in trading. I have a very strong bias. I think you will see yields lower. But again, we need to see some more catalyst on the macro side or geopolitical side to move rapidly beyond 6 easings. I prefer to look for a spot where 3 to 4 easings are priced in to trade long to the front end. I think the curves globally in the US will steepen. But I think the nice part about the markets in macro, again, that will keep volatility high is the relative paths of interest rates in Japan, the US, Europe, and the UK are going to vary. And the change is going to start to pick up in 2024 as both the growth and inflation dynamics and the policy responses move at different speeds, and in some cases in different directions in the case of Japan.
No, that's great. I mean, it's been fairly sort of comprehensive overview of markets here. In terms of trades or views, is there anything else that's on your radar for this year?
I think that covers it. I think the key things are in currencies: yen outperformance, Swiss underperformance. The higher beta currencies, Aussie, Kiwi, Canada, NOK will provide substantial trading opportunities. Alpha is going to be important. Fixed income is a buy into weakness. Emerging markets will generally outperform. Brazil will do better. Turkey is a wild card. I'm still bearish China, but it needs to be traded. In Asia, the one place that might do better than others is Indonesia, where it's the only pair with positive carry. FDI is growing. They're becoming highly levered to the battery industry and nickel processing. And post the Taiwan elections, Korea may do better, and that will be related also to AI in the US.
No, that's great. Very, very comprehensive. Now, I just wanted to round off with a couple of personal questions I like to ask all of my guests. The first one is, you've obviously been in markets for a couple of decades now. What's the best investment advice that you receive from anyone that you've worked with or even not worked with?
I'm going to give you more than one answer. And I'm seeking out advice every day as part of continual improvement. One is trade with the wind at your back. And this has applications to utilizing carry and drift to your benefit. Be careful on counter trend trades. If you're doubtful and the trade is losing, just get out. It gets back to your question on risk. So trade with the wind at your back. Also, in an ode to open-mindedness, recognize that everyone knows more about something than you do. Ask questions, find people to challenge your trades and your investment views, and be open-minded continually as to where you could be wrong. The others are, process and routine. And again, this gets back to your question on risk. You need to, at times, just step away from the markets, have a reset, but you need to follow a process and a routine, daily, weekly, monthly, yearly. And that includes, how you view trading, exercise, meditation, diet, family, social routines. I find once I get out of a routine, it's challenging to get back in, and my efficiencies go down. And the other is, generate and create a differentiated approach to things. And the last one I would say is recognize your weaknesses and improve upon them. For me, the weakness has been, at times being too much of a contrarian. And that means sometimes I get into markets too early.
Okay, that's great pieces of advice there. Now, the other one was a question of what advice would you give to younger people who are, soon to leave university or have left university and are entering the real world?
Make sure you love what you're doing. And it's even better if you have a talent for what you love to do. Find good mentors. Look for a consilience in things. I find it very interesting and productive and additive to learn from and embrace non-traditional sources in your work. So, for example, consider, what history might mean for markets, what linkages there might be to nature, biology. And I think that will really enrich and differentiate what you're doing. Again, part of my habits, have a routine, always be reinventing yourself. And, I would also take something from the Amish, who have something you probably know about the law called Rumspringa, which means, at, a certain age for the Amish, it's usually 16. It can be any age. It could be when you're 50. It could be when you're 70. It could be when you're 30. Take some time off, reevaluate what you're doing, evaluate where you want to go. And that is, a very important time for a reset, a recharge, and coming back with, a new energy and approach to whatever you're doing.
That's great pieces of advice there. Now, I also wanted to ask you about books. What are some of the books that have really influenced you?
So my books tend to be very varied. They're on market history, math, nature. I've been reading some books on magic and illusions lately, some bios. Let me give you a few examples. One is a book called Horse Trading by Ben Green. It's super funny. It's obviously about horse trading, but it teaches you about markets, knowing your buyer, don't rush into quote unquote good deals, and to listen carefully.
That's great. Yeah.
Another one is A Man for All Markets, about Ed Thorpe. Statistics Without Tears gives you a good foundation in stats. One I've been reading recently is called High, A Journey Across the Himalayas, which is a great travelogue, similar to some of the Paul Thoreau books that I liked. And in this case, it's through an interesting part of the world that's not often talked about, Pakistan, India, Bhutan, Nepal, and China. Another great book that I've gotten a lot out of is by a gentleman named E.O. Wilson, called Consilience, the Unity of Knowledge, which talks about unifying different branches of knowledge under a common framework and the linkages between them. I think this has a lot of applications between tying trading, the psychology, market patterns, physics, biology, all into kind of one schema.
That's great. That's a fairly diverse and comprehensive list there. So that's thanks for that. And then finally, just to wrap up, I mean, what's the best way for people to reach out to you or to find your thoughts?
Well, hopefully you'll invite me to write some more pieces for your Macro Hive site and the illustrious team that you have there. I think it's you've done some incredible things there with Andrew and the entire team. So that's one way. The other way is, and you can put this at the end of the podcast, is my email, john@floydcapital.com.
Right.
I've an old story is when I first started on the trading desk at Merrill Lynch, I was reading about George Soros and Jim Rogers. And I decided to call the directory assistants at the time, I think it was 411, and asked for Jim Rogers' phone number on the Upper West Side of Manhattan. And I called them up and they took a message. And 5 minutes later, Jim Rogers called me back from Alabama. And we had a nice long conversation about trading and marketing. So I have a policy of always answering phone calls and emails. So I encourage people to reach out anytime.
Yeah, that's a fantastic story. Yeah, we've had Jim Rogers as a podcast guest. He's excellent. He's a great guy. So with that, I mean, thanks a lot, John. It was fantastic speaking to you, and I think you really have done sort of full justice to being the first podcast for the year, and hopefully you'll add a lot of value to all of our listeners at the start of Jan.
Thank you, Bilal. That's an accolade from you that I'm very happy to get. I appreciate that. I wish you the best in January and all of 2024. Thanks for having me.
Great. Thank you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.